Well, good morning, everyone. That's our monthly signal that it's time to begin. So I will call the meeting of the May 11th, 2023 Oklahoma City Employee Retirement System to order. Item number 2 on our agenda is to approve the minutes of the meeting of April 13th, 2023. I have a motion and a second. Please record your vote. Item is approved. Item number 3 is the consent docket. We have 2 items. We can take those with one motion. I have a motion and a second. Please record your vote. Item is approved. Item number 4 on the agenda is to ratify approvals. I have a motion and a second. Please record your vote. Item is approved. Okay, I got to slide down here. Item number 5 is to approve the claims docket. I have a motion and a second. Please record your vote. Item is approved. Item number 6 is to approve the following applications for service retirement. I have a motion and a second. Please record your vote. Item is approved. Item number 8, receive report of death. Item number 7. Receive report of death, authorize payment of the $5,000 death benefit, and authorize secretary to make necessary changes to conform on the following. Motion to second. Record your vote. Item is approved. Now we're on item 8. Receive report of death, authorize secretary to make necessary changes to conform on the following. I have a motion to second. Please record your vote. Item is approved. Item number 9 is items for individual consideration. Item number 9A is amendment number 1 in restated audit contract with Allen Gibbs and Hulick LC to include audit services for fiscal year 2023, fee not to exceed $25,994. Any questions? Hearing none, Chair will entertain a motion. Have a motion and a second. Please record your vote. Item is approved. Item number 9B is to receive the quarterly investment report. Good morning, Jason.
Quite a stack of paper in front of you this morning, so I have a number of things to cover. I'll just start off on the quarter report. If you want to, Regina, turn to page 8. Just a market overview. As we've talked the last several months, we have seen a pretty big bounce back in the equity markets, although it's still a bit choppy as concerns about rates, the impact on inflation and the economy potentially slowing due to rising rates, and regional bank issues is really tied to the rising rates as rates have gone up, and it's made it challenging for banks to raise their rates that they pay depositors. You've seen a significant amount of deposits move from banks into money market funds, creating some of these issues, or really the issues with the regional banks on their balance sheet and some problems, which is reflected there in the small cap. You don't necessarily see it here in for the quarter or the year-to-date number. That's the quarter, but in the month of March, small cap was down quite a bit, primarily small cap value, which is comprised of a pretty significant amount of financials and regional banks. But for the year, through the end of March, large cap stocks were up 7.5% for the quarter. EFI, or International Developed Markets, were up 8.6%. One-year numbers, while still negative across most asset classes, EFI's down 86 basis points. If we roll that forward and looked at the 9-month period from June through March or April, they're actually quite positive, double-digit returns. And this is, as we talk about frequently, as a long-term investor with long-term liabilities, while it is difficult as we're going through challenging market environments, sticking with that plan and with your asset allocation and rebalancing back to targets is critical, because we can't time when things are going to turn. If we just go forward a few pages to looking at your portfolio on page 20, this is looking at dollar amounts, and I'll just go to the 10-year, because it's certainly, as we've talked about, a very strong period. This is all time periods ending March 31, 2023. For that 10-year period, this is going back to 2013. At that point, the plan stood at about $571 million. Net additions, which is contributions in from participants and the city, less benefit payments out and other expenses, about $247.5 million. For a mature pension plan, this is to be expected that you'd be in a net negative cash flow position. But over that period, the plan return on investment has been just under $500 million. So you ended that period at March 31 with $820 million. And you can see a big bounce back in the quarter. The plan was up $28 million for the quarter, still a one-year return there of negative $55 million, but certainly bouncing back from that. The next page just looks kind of very black and white at objectives. We know that in shorter periods of time, we're not going to meet all of these, but we have very broad level portfolio objectives over the long term, looking at primarily we want to exceed the actuarial rate of return over a long-term time horizon. Now, the way your actuary measures this is a little bit different, because they're not measuring it on a monthly basis, and they're not measuring it based on market value of assets. But nonetheless, if we look out over 10 years, you've exceeded that 7% actuarial rate of return hurdle. More recently, over the last 5 years through the end of March, the portfolio has grown at 6%, so a little bit less than that, about 1%. But again, we're not measuring the same time periods. A secondary objective is outperforming the policy index over time. This is an indicator of are the managers outperforming the asset allocation over a 10-year period. You've outperformed by about 50 basis points. More recently, slightly below. I'd say it's basically in line with the policy index, 603 versus 6.1. Some of that has been a couple things in the recent 3 years. Large cap, which is your largest allocation, which is primarily benchmark risk controlled. It's about 50% passive and 50% in Intech, which is taking on some deviations relative to the benchmark. That has trailed a bit, and we talked about that a little last month. Just from a drill down perspective, and I said last month that we'll do a deeper dive this month. I'm going to have some comments, but we'll do a deeper dive next month, because we have a number of other items today that we wanted to cover. But just for perspective, on a calendar year basis, just trying to isolate where this dispersion in the large cap has come, because it is 20% of your portfolio. So as we look at the policy benchmark, the policy component for large cap is the S&P 500. Intech strategy is measured against the Russell 1000, which is another large cap US equity benchmark. Those indices tend to track one another fairly tightly over time, but recently there has been some deviations there, particularly in 2021 and 2020, where the mega cap stocks, the largest growth names, have really led the market. And really, even in this current period, ending in April of this year, we've seen a handful of stocks, again, lead the market. Microsoft, Apple, Amazon, Google, or Meta, really leading the market. And when that happens, the cap-weighted benchmark S&P 500 tends to do better than the Russell 1000, and certainly better than an Intech strategy that is trying to capture volatility in price of the smaller names within the benchmark. So calendar year 2021, the S&P 500 was up 28%. The Russell 1000 was up 26%. So just the two benchmarks, there's about 2% deviation there. Intech in calendar year 2021 was up 21.16%. So that relative to the S&P 500, which is in your policy benchmark, that's the biggest dispersion, that 1 year period. The year prior to that, Intech was up 24% relative to the Russell 1000, up 21%, and the S&P up 18.4. In 2019, Intech was up 32%, and both benchmarks were roughly 31.4%, so in line. It's this most recent period that really from 2021 through now that has caused that dispersion you'll see there, and then on the next page is when we drill down a little further. Go back, keep. That's right there. The other metrics that we look at are risk, because we talk about return, but it is important to, we've built this portfolio to participate in up markets and protect in down markets. It's not about just getting the highest return, it's getting the highest level of return for the amount of risk that you can tolerate. With a long-term portfolio, we know we have to take equity market risk or volatility to reach that 7% target, but we'd like to do it with a little bit less than what the market would suggest, and that's why you have some strategies within your portfolio like hedged equity or fixed income, and some of the strategies within fixed income to mitigate volatility. What you'll see here, over both 5 and 10 years, the standard deviation or volatility of the portfolio is lower than that of the benchmark. The beta, which is the sensitivity of the portfolio to the direction of markets, is a little bit lower than the benchmark. The benchmark would be 1, your policy allocation. You're a little bit lower than that. And your down capture. What that is looking at is when your policy index is down, how much of that are you capturing? So 100 would be you're in line with the policy benchmark. Over time, you're getting about 90% of the downside. So as time goes on, by losing less, your assets compound at a greater rate. So from a risk standpoint, over long term, you're getting the return you need, and we're doing it in a risk-controlled fashion. Finally, if you just want to go to page 24, Regina, just look at a couple of other relative benchmarks on the right side of that page. The quarter in this bounce back, portfolio up 3.5%, trailing the benchmark a little bit. More important is looking at those 10-year numbers. We're comparing you to a couple of different metrics. One is other institutional tax-exempt portfolios that have a similar risk profile, 55 to 70% in equities, and then the other is other public pension plans. So if we look at 3, 5, and 10-year basis on a relative to other institutional investors with a similar risk profile, you're in the top 40% over 3 years, top 36% over 5 years, and the top roughly 30% over 10 years. relative to other public pension plans, you're right about the median over that time period. And this bounces around, as you know. When we looked at this in 2021 or 2020, we were way ahead. But I think looking at these other metrics, we're about where we'd like to be. So now if we just turn to the ASAP, if you will, the monthly report, before I get into some other action items. In terms of the asset allocation, the portfolio is roughly in line with the broad target asset allocation, 65% to equity, 20% to fixed income. You've got $12.3 million in cash, and I know that fluctuates, but currently cash is offering a yield similar to bonds, so we're comfortable holding a little bit more cash right now. So if you add that to your fixed income, we're right at about the 20%, and then real estate, just slightly underweight, and that's primarily the opportunistic real estate. We've got some commitments made in the opportunistic real estate space over time. That core real estate will come down and we'll fund some of the opportunistic real estate with that. Within equities, we have recently made a change this year to your target allocation within equities. We did not change the broad equity fixed real asset mix, but within equities, you reduced long-short equity from 10% to 5% and increased private equity from 10 to 15%. So you'll see there's deviation there on both sides. So our private equity, it's going to take some time to get to that 15% target. We're going to talk about a couple of commitments there today to complementary strategies to what you currently have, and also a pacing plan as to how much needs to be put to work or committed per year to get to that 15% target in a reasonable amount of time. And then also on the long-short equity side, we have some recommendations for redemptions. We've made some recently. We're making a few more. One is for a complete redemption from one of the underlying strategies in the K2 Ascent platform, where there's some team turnover related to withdrawals from the strategy and performance that we want to get in front of. And then the other three others are really just rebalancing to trim positions and get us closer to that target. If you want to just flip the page, then. As we roll forward a month now, the one-year return of the portfolio still slightly negative on a net of fee basis, down about 1.2%. And you'll see relative to the policy index that we're behind it by about 2%. And almost all of that is large cap. We're overweight to large cap, and really it's been driven by this the overweight and the underperformance of the non-benchmark piece of that, the Intech piece. And I pointed out it's really been in the last year and a half as mega cap names and that handful of names have outperformed. That's really driving that. Your small cap portfolio on a one-year basis is provided protection, down 2.5% versus the Russell 2500 down 3.3%. Long short equity, it's making it. We're seeing a bit of a comeback really since June of last year as the market has turned around. We don't expect it to be up as much as the ACWI, certainly, but relative to the HFRI, which is other directional-oriented or equity-oriented hedge fund strategies, we've got about 100 basis points premium, 90 basis points premium return there. Certainly starting to see that pick up a bit. Private equity, last year, 2022 and 2021, private equity was a big driver of return. In 2021, it was due to significant realizations where companies were being sold in a strong market environment. In 2022, it was more a result of a lag in valuation impact. As public markets were down, your private equity investments, you weren't seeing marks as they're not marked daily, they're marked quarterly, and there's a lag. So private equity held up from a valuation standpoint in 2022. We're starting to see managers in the portfolio reflect market conditions. And so you're seeing some markdowns in the portfolios. And now when equities, public markets have gone up, you're seeing a negative return for private equity. And that's another piece. In the policy index, we measure private equity against the S&P 500 public market benchmark. So that's creating some dispersion there. Over long periods of time, as we'll see when we review the private equity portfolio in detail, your private equity allocation has added a significant amount of return. If you go all the way out to that 10-year number, 15.6% return for your private equity allocation relative to the S&P 500, up 12.2. So we're getting that premium to public markets that we're looking for. Non-U.S. side, while on a year-to-date basis, a nice absolute return, trailing a little bit, up 9.3. The EFI's up 11.8. See, some of that is on the Lazard, your value manager. Not a real deep value manager, as values performed fairly well through 2022. They lag that value benchmark a bit, and that's having some impact there, but we don't have concerns over the managers there. Finally, on the fixed income side, the roll-up of all your fixed income is essentially flat. I think the important thing to remember when we talked about asset allocation at the beginning of this year, 2022 was the worst year in fixed income in decades, if not ever. And it's a result of interest rates going up 5% on the short end of the yield curve. As rates go up, bond prices come down. Your fixed income portfolio actually provided some protection. If you look at that 3-year number, down 79 basis points, where the benchmark was down 300 basis points over 3 years, or down 1.1 net of fees and 300 basis points for the benchmark. That's because of some of the diversifying strategies that you have there, particularly the PGIM absolute return strategy that takes a lot less duration risk in the portfolio. It was implemented in the portfolio for just this reason, to mitigate against sustained low rates to rising rate environment. Going forward, your fixed income is much more attractive today. The yield on your fixed income strategies is significantly higher, and with a higher yield, even if we saw rates go up, whereas that's not the expectation so much right now for intermediate to longer term market rates. The expectation is actually that they'll come down, and they have. Short end still going up as the Fed's fighting inflation, but having a little bit of that duration now should be somewhat helpful. I'm just going to get the yield on these portfolios today. On the SSGA index fund, the yield is 4.4%, the annual yield. On your Western strategy, the yield is 6%, a little over 6%. So that makes up a significant portion. That's the largest allocation within your fixed income allocation. And the PGIM absolute return yield on that is over 7%. So just from a yield standpoint today, you're in a much better standpoint than we were a year ago when rates were effectively 0 to 2% in the short to intermediate part of the curve. Any questions on the portfolio quarter report or the monthly report before I move to the other action items?
Let's go ahead and approve items B and C, and then we can move on. So item B is to receive the quarterly investment report. I have a motion and a second. Record your vote. Item is approved, and now for item 9C, to receive the monthly investment report. We have a motion and a second. Please record your vote. Item is approved. And that takes us to item 9D, which is private equity portfolio review.
Okay, you have this, it's the clear covered book in the stack of papers that I put in front of you all. So as I mentioned, earlier this year, we made some modifications to the strategic asset allocation, reducing long-short equity from 10 to 5% and increasing private equity from 10 to 15%. Currently, our private equity allocation is at about 8%, so it's going to take some time to get the portfolio to that 15% level. As you are aware, we generally, with private equity, it operates differently than other asset classes in that our team is constantly keeping aware of a pipeline of strategies that are in the market, are going to be in the market, meeting with firms, doing our due diligence and evaluation, and then coming to our clients when we have identified funds that we think are appropriate to complement your existing portfolio and also compelling and on their own. And so it is a regular, you have to continue to feed the private equity program because as you make commitments and the funds draw down capital, your older funds are realizing and selling investments in their portfolio and they're sending money back to you. So to get and reach your target, we have to continually make new commitments. Page 5 here, this is just a review of your private equity portfolio. We're comparing your private equity portfolio here to what we call a public market equivalent. This is one way that private equity is measured in addition to looking at vintage year private equity commitments compared to similar vintage year commitments. What this is doing, because your money is called down over time and distributed back to you over time, we're looking at if those contributions and distributions were invested in the S&P 500 on that date and then come out of the S&P 500 on that date to get a apples to apples comparison. So what we see here, over the 10-year period, your private equity portfolio, and this is net of fees, is up about 16% annualized, whereas the S&P 500, the number's not in there, but the S&P 500 plus 250 basis points, which is a premium, I guess I could do the math, it's 11.9 would be the S&P 500. The S&P plus 250 is 14.4, and then the ACWI, which is just a global equity benchmark, is up 7. So over the 10-year period, certainly outperformed. Since inception, and this is going back to April of 2009, just about in line, ahead of the S&P 500, about 30 basis points behind the S&P plus 250. So I think certainly getting what we're bargaining for there. And why do we look at that 250 basis points? Because these investments are illiquid, we expect to get a premium for that illiquidity over time, not in the short term, but over the long term. The next page just looks at your portfolio kind of all rolled up, and you can see the funds that you have made commitments to on the left side. The inception date is when your first capital was drawn from those funds. The committed is how much you've actually committed to each of the individual funds, and then the top line is the total. So since 2009, you've made $134.5 million in commitments to private equity across venture capital, buyout, special situations, or distress strategies. To date, so through the end of, this is through the end of December, and I have, the ASAP has this more updated. Through the end of December, 81.1 million was drawn or invested. That's how much was invested in companies. Through the end of April, it's 82.2 million. Your remaining commitment is 54 million. So that's to these existing funds there's still $54.7 million to be drawn. Distributions to date, that's how much has come back to you in cash, back to the system, $61.7 million. The adjusted ending value, that is, it's really your net asset value today invested, and again, this is at the end of the year, $72.1 million. At the end of April, it's $70.4 million. And then the total value of $133.9 million. It's about, that total value is the adjusted ending value, or the current NAV plus distributions back to you. So if we look at that number, that's about $1 million less than you've committed. So it's been almost funding itself at this point for a 1.65 times total value to paid in ratio. You'll see on the next page, we break down by vintage year and by type. If you go to the next page, Regina. So effectively 55% of the portfolio is in what we'd call dedicated venture and growth equity. Most of that growth equity, that is later stage venture, and some of what Warburg Pincus is doing, it could be considered buyout as well. A lot of that is Warburg Pincus, and you've done 3 Warburg Pincus funds, 2012, 2015, and 2021. And we really have started out using that as somewhat of a foundational piece in the portfolio, because it provides such broad exposure for a direct fund across the private equity market. That second bullet there I think is important, and it ties to the chart on the right, or the pie chart on the right. As far as vintage year, nearly 75% of your portfolio's exposure is commitments that were made in 2019 or more recently. And what that means is this is still, even though you've had an allocation since 2009, your current private equity portfolio is very young. I mean, you're still in the early stages of developing this program. Most of your investments are just in the cultivation, what we'd call the cultivation phase, where they're trying to make improvements and to get them to where they can sell them. We want to go on to the next page. So we try to map out your private equity portfolio similar to how you would think of maybe the 9 style box for equities, with U.S. Core, growth and value, large, mid, and small. Look at it through a little bit different lens, really on the life cycle of companies. Venture capital, really when we talk about venture capital, we're primarily talking about very early stage ideas. Primarily this is going to be technology, healthcare, business services, but technology oriented. Buyout is more mature companies. You could have a lot of industrial manufacturing in this, but these are more mature companies, not ideas necessarily, where they need some kind of either financial injection to the company, or operating injection of professional management. Oftentimes you're seeing family-owned or companies that were privately owned needing to move to the next level. And then on the far right, special situation, this is turnaround and distress. So think of as companies go through the life cycle and they may not be doing as well. Could be public companies that are challenged in the public markets, and their stock is trading down, but it's still a good company. They could be taken private into the private markets, and that early on within your private equity program, we did that through the Sigler Guff Distressed Opportunities Fund, which is a fund of funds. And if you think about the timing of that, that was in 2009, one of your first commitments coming out of the financial crisis in 2008. Very attractive time to be putting money to work in distressed, as a lot of companies are distressed. We're potentially coming into that environment again. But you did Carval. That was done in 2020, just following during COVID. We really thought the opportunity was going to be pretty compelling for distress. They've been slow to put money to work in that strategy because that just didn't immediately present itself because markets bounce back so much. But that has started to come around, and they're going to be coming back to market later this year. So these funds in yellow. As we look at, so the funds in gold are current managers that are in market. Apollo and Carval are two strategies that you have. Sawmill and TrueBridge, you see those two on here, are two new strategies to you all that we think would be good complements to round out your allocation that you have today and complement your existing portfolio. So TrueBridge is, and I'll go into more detail, TrueBridge is a fund of funds, so like your Singular Guff and Mesero, and we've moved away a bit from fund of funds and trying to do more direct, but in the venture space, early stage venture, it is a bit more challenging to build a portfolio of enough venture capital funds, particularly for public pension funds, to get into some strategies that we do think fund of funds make sense. The founders of this came out of University of North Carolina, have some deep relationships. What we're actually going to be proposing is two different funds from TrueBridge. One is a primary fund in which they're going to be committing to newly established venture capital funds over the next 3 to 5 years. The other is a secondary fund. A secondary fund is they're going to go in and buy interests of either funds from investors that need to get out for distressed reasons, but these would have been funds that were started in 2013, 14, 15. So you're getting immediate exposure to some older vintages. And in that fund, they're also may buy individual companies from VC funds. So you're drilling down a little bit further and mitigating a layer of fees. Sawmill is a small market buyout fund. We've got quite a bit of exposure through, as you see on this chart, Warburg, CD&R, which is Clayton, Dublier, and Rice, a new commitment, and Apollo and Francisco. In the mid to large market buyout, don't have much exposure, if any, to small market buyout. And this would be more mature companies, industrial, manufacturing, business services, not really technology-oriented like Francisco Partners is. And these are companies that are 20 to 30 million in earnings. A much smaller fund size, they're raising $400 million. So that's an area we don't have much exposure. The next slide just looks at a pacing plan. As always, I'd say this is a moving target. I know, Suri, last time you asked about this. This is a moving target and it adjusts. So these numbers, this 30 million a year, that's today. That we think if we made commitments of $30 million a year, that would drive us to that 15% target allocation by 2028. We're taking a pretty conservative approach to get there. I mean, you could say, well, why don't we do 60 million a year and get there in 3 years? We want to be conservative because we know this is a moving target. But roughly at 30 million, what we do with this model, it's looking at your existing investments, and we're talking to those your existing fund managers and just getting their best sense, and then we apply our judgment as to what it looks like going forward in terms of capital calls and more importantly distributions coming back to make some adjustments going forward on the projected distribution line. And you'll see in the next couple years, we're not projecting a lot, and that's because the portfolio is so young, that 2019. As we get out further, those distributions should come up a little bit, but contributions, that should go up more because we're making new commitments. But that $30 million number, I'd say that's pretty conservative, and we think that could be 3 to 4 fund commitments per year, and now we're talking about really 2 here today to get us about a little more than halfway there. Any questions on this pacing plan? Okay. Let's move forward to the individual. This is the pipeline. This isn't the complete pipeline, but we just wanted to put this in front of you. So, you know, we're having to work in advance because these funds open and then they close. And we got to get our work done due diligence wise early on, make sure we're comfortable in our underwriting process before we come to you with a recommendation. But both of these, or all three of these funds, two firms, we've got a little bit of a window, but not much. As we sit here in May, these are probably going to close in Q3, so probably October of this year. So the process, we make a recommendation to you, depending on what the board's decision is. If you approve it, then you've got a couple months for legal review and just negotiating the document. So we've got some time, but all of these are pretty highly sought after again, and we don't anticipate it's going to close before that, but it's always a moving target. On the forward looking, you know, we have some other names on here. I'd say Carval is one of your existing managers. That's probably something that we're going to be looking at for the second half of the year, adding to that distressed special situations component. We think that opportunity and is probably a good one. These others are a couple of are really small. The light blue are small market buyout, and then the Santana is a venture fund. This isn't necessarily saying this is what we think we'll come back to with you. This is just our pipeline right now, but I'm telling you that the Carval strategy is probably one we will. So if we go to the fund evaluation ports, let's go back to the first page. There we go. Sawmill Capital Partners 3. So this is the third fund for Sawmill, led by Howard Unger, who founded the firm in 1997, and then Tim Nelson and Scott Rivard, who have been there for some time. This is, as I said, a middle market to small market buyout strategy. They're going to be focusing on business services and distribution. Down in the lower right, I think, are some of the characteristics that are important. Focused on North America. The number of investments in this portfolio, this is only going to be 10 to 12 underlying companies, and these are smaller companies. Enterprise value, 50 to 200 million. So these are small companies worth 50 to 200 million that are making between 5 and 20 million. Historically, small market buyout has been a pretty attractive area in the market to generate return. They're going to be writing checks of $20 to $50 million in these companies, so taking a pretty significant interest. This is very different than what Clayton, Dublier and Rice and Francisco Partners are doing, or even Apollo or Carval. They're writing oftentimes $200 million or $300 million checks for much bigger companies, so this is a little bit different area. If you go to the next page, much like we showed the portfolio's performance, this is looking at the prior fund performance for Sawmill on a public market equivalent basis, so comparing their cash flows, if you would put that money into the S&P 500 or the Russell 2000 small cap, their 2007 fund, which is actually a pretty attractive time to put money to work. Probably most of those dollars were put to work during and after the financial crisis, so at fairly distressed prices. That fund's returned 19.6%. relative to the S&P at 12.6 and the small cap at 12.3. Their more recent fund, while not fully realized, there's still a lot of value in that fund, and it hasn't been distributed on a valuation basis, up 25%. Other ways to look at it on the next page, and this is more comparable for how we look at comparing one fund to another of its similar ilk, more peer group analysis. And we break this down to a third component, which was pre-fund. This was the founder, Howard Unger's. He was doing this. He came out of Chase Private Equity, their private equity group. When he started Sawmill, he was doing more bootstrap investments. He didn't create a fund, but that pre-fund 98 to 2005 are those investments where he's raising just money on a deal-by-deal basis. 105 million in investments, turned that distributed 459 million, which is a 3.8 time multiple or 64% IRR. We don't compare that to any, from a peer group standpoint, because there's no vintage year, it's over a longer period of time. But you see their Fund 1 and Fund 2 comparables. The Fund 1, which is mostly realized at this point, there's only 16 million left in unrealized value there. That generated a 2.6 time money and a 19.6% IRR. Compared to other 2007 small market buyout funds, it's in the first quartile for total value to paid in, which is that 2.65, the IRR, and then the distributions. The DPI is how much they've given back. And that's important over time. We don't want to just see in the interim before it's fully vetted that they created value based on marks. They actually get money back to investors. And then the 2016 fund, which is certainly a much newer vintage, it still has there was 282 million that has been invested. They've distributed 49 million, about 500 million in value, so close to 2x multiple there. You see the IRRs in the first quartile, the total values in the second. The DPI, it's a new fund. They haven't distributed a lot of capital back. So we think this is a very compelling opportunity that would complement your existing portfolio well, and I'll get to that commitment amount in a moment. The next fund is TrueBridge Capital Partners Fund 3. As I mentioned, TrueBridge is a fund of funds. It's going to provide exposure to venture capital. This is more early stage technology, healthcare, biosciences. Right now you have a couple of commitments there to direct funds in the first mark funds. They're going to invest in, see there in the bottom right, 12 to 15 managers, individual managers. And those managers will have between 10 and 20 individual companies in them over time. So this portfolio will have 400 to 500 companies in it, very different than what we're talking about with Sawmill. And this is a higher risk, higher reward strategy, potentially. Ed Poston and Mel Williams, as I mentioned, we've actually known them for some time. They came out of the UNC Management Company, which was University of North Carolina's endowment. So they had strong relationships there. It was the investment management company for the endowment. They started this firm in 2007. You'll see on page 16 the track record, the performance of their prior funds relative to the S&P 500. And here we're comparing to the NASDAQ, which is more technology oriented, very strong returns versus the public market equivalent. And a similar story on the next page versus comparable venture funds over that time. They're essentially in the first quartile and for all metrics for all of these funds over time. We think a good complement here. This fund, again, it is a fund of fund that's going to invest in other new primary venture capital fund of funds. The other TrueBridge offering is their TrueBridge Secondaries Fund 1. So as the name, and go to the next page, the name evokes, it is their first secondary fund. However, they've been making secondary investments in their primary fund since inception. So they've made a number of secondary investments. And again, what that means is this fund is going to invest in mature partnerships being sold by generally distressed sellers or sellers that need to rebalance their portfolio. In market environments like we're in today, some folks may be over-allocated to private equity or just challenged in their portfolio and need to get some liquidity. And so it is a compelling environment right now to go and buy on-the-run private equity funds or individual companies at a discount. This fund will have 15 to 20 investments. 40 to 50% of that is going to be in direct companies, not other funds. So it'll just be a secondary investment in a company where they'll generally have a board seat or an advisory board seat or some influence on that. That's attractive as well to us. Not only are you getting money to work a little bit faster, you're mitigating the second layer of fees that comes with a fund of funds through those direct investments. Some of this, up to 35%, could be outside of the U.S. in this. And you see on the next page their fund and direct secondary investment. They've done 55 deals. 43 were direct, so these are individual companies where they've invested $227 million and they've generated a 2.6 multiple and 32% IRR, so very compelling. So we think the combination of these two, we really look at it as one venture capital offering, even though they're two funds, really rounds out your venture capital allocation, which today is really just in the First Mark Fund. So our recommendations are on slide 22. It would be for a $10 million commitment to Sawmill Capital Partners 3, the small market buyout fund, and then $5 million commitment each to TrueBridge Capital Partners Fund 8 and TrueBridge Secondaries Fund 1.
Okay, I apologize, had the nature called. So where are we?
Our summary recommendations.
Okay, so any questions, I guess, on items E, F, and G, right? Okay, hearing none, let's do item E first. Chair will entertain a motion on item 9E. Have a motion, a second. Record your vote. Item is approved. Chair will entertain a motion now on item 9F. Have a motion, a second. Record your vote. Item is approved. And finally, item 9G. Have a motion, a second. Please record your vote. And that item is approved. Okay.
Mr. Chairman?
Yes, sir.
I would just like to just tell Jason, thank you. Just your due diligence and the way you go about this. Randy and I were kind of talking offhand about that over here, and you do a great job, and we've got a lot of support for you and confidence in you, and so we appreciate what you did there.
Thank you. Appreciate it.
Yes, Mr. Chairman. Your firm have any comments on the banking situation right now?
Well, no more than what I made earlier, and it's not a firm, it's just my own statements as to what's happening, and I think there's probably some ongoing concerns and fallout that we're going to see. As I said last month, for you all as trustees of public pension assets, the first and foremost is knowing that your cash that's held in custody at your custodian bank is not considered, it's not a deposit account, so it's not an asset of the bank, it's your asset held in trust and custody for you. With respect to investments, this is why we have diversification in the portfolio. You're not immune from the investment risk, but it's a pretty small percentage. I don't have the actual number in your portfolio of exposure, but as we've looked at other portfolios, exposure to regional banks is pretty low, some of which is because if you had Silicon Valley Bank or First Republic, it's zero now. But just looking here, within Earnest Partners, financials make up, they're underweight financials relative to the benchmark. I don't know how much of that is regional banks, but I think that the point I'm making, diversification across asset classes is important. The implications of what's happening right now, we think that there's probably more to come, whether it's, if the banks are having a hard time raising depositor rates and you just see folks moving cash. It's a bit surprising to us, I guess. We never thought about it. How much cash was sitting on in bank deposits out there. I think, as Brent, I'm sure you've looked at this in your other accounts. I mean, I think institutions, cities, states, companies are really revisiting their treasury management and where that cash is today. But for the pension fund, I think I'm not saying there's no issue, but that's.
Okay, any other questions? Okay, we will move on to item H.
Okay. So this is just following up on really the new strategic allocation where you've reduced your target allocation of long-short equity from 10 to 5%. In February, we're currently at about 8%. Currently, the K2 Ascent fund, that is what you're invested in. It is a unmanaged fund of funds. And what I mean by that is, unlike what you had previously with K2, where you invest in their off-the-shelf, you get what everybody else has. This is there's a platform of funds available that have been diligenced by K2 and by ACG that you're able, from a administrative efficiency standpoint, it is a single commitment to the K2 Ascent platform. And then you can pick and choose the funds on the platform and rebalance among them, get in and get out based on really our recommendations and K2's recommendations to you. Currently, there are 10 different strategies. You've made a couple of redemptions, Trian, SQN, and Swift Current that are, Trian has been completed, SQN and Swift Current are going to be happening, and those were for performance and positioning. We talked about this last year. We felt that we had a bit too much growth and technology exposure. Currently, there is the most pressing and imminent is Suvretta, which is another, it's actually currently your largest allocation on the platform. It's about 10.4 million, 1.3% of your total portfolio, but 15% of the long-short allocation. Suvretta has had disappointing performance recently, but what we've noticed is some outflows from the strategy, and then we have concerns about departures on the team. The ability to get in and out of these requires some notice, and actually there is quarterly liquidity in this fund, but it requires 50-day advance notice. So to get out of this fund on June 30th, we need to get in the redemption today. It just so happens to be today. So otherwise we're going to have to wait until the end of September. So we're making a recommendation for a full redemption from K2 Suvretta Partners series effective June 30th. In addition to that, this is more for rebalancing, not any concerns over the managers, just because you're overweight to long-short equity. And some of the managers have done a little bit better than others and are representing a higher weight. We're recommending putting in partial redemptions to K2 Engaged Capital Flagship Fund Series and South Point, K2 South Point Qualified Fund Series for $2 million each, for a total of $4 million, and to the Starboard Value Opportunity Fund for $1 million. These, again, not any concerns about these funds. These are just rebalancing, and that has to be put in. And just from an efficiency standpoint, we would recommend you do it. There's one redemption form. We can put it all in at one time. They're not, all that money's not going to come back at the same time. So the last item, we are going to hold off on that. We're not, we've decided we're not prepared to make that recommendation. We want nothing to do with the fund. In light of the treasurer's, state treasurer's evaluation of firms, and this is related to energy, oil and gas boycott. The treasurer issued a letter last week putting 13 firms on a list of what they've determined to be energy boycotting firms. I think there's still a lot of questions. That doesn't apply to you, I know. This strategy is not focused on energy at all, but it is, they would describe themselves as a ESG manager. Our due diligence has evaluated them. It's really on governance that they're focused on, coming in and making changes to board governance and operating governance. That said, in light of this, we want to go back and do a little bit more work and get some confirmation on just their position on energy and oil based on what's happening. So today, the only recommendations are for these redemptions, and we're not making that new commitment recommendation. No, we're good. We're good.
Okay, does anyone have any questions on Jason's recommendation? Okay, hearing none, since we are not going to do the final item, the contribution to K2 impacted, I'm going to entertain a motion to amend item 9H to exclude that contribution. So I need a motion on that, to amend.
I'll
I have a motion and a second to amend the item. Record your vote. The amendment is approved, and now a motion and a second is needed to approve the redemptions included in item H. Motion and a second, please record your vote. And that item is approved. So, thank you, sir.
Thank you.
Moving along, item number 10 is comments from board, staff, and citizen. Mr. Lawson, I see somehow you got past security.
I'm biting my hand off to keep from asking a question.
Okay, well, that's much appreciated. Any other comments from board and staff? Regina?
I do want to remind anybody that may watch that the election goes through May 19th.
Right.
And also on May 19th, the city is welcoming the Social Security office at the Mike DiGiacomo room at 2 p.m. to speak on Social Security and Medicare. So you can sign up through the training center, or please tell your staff. We want our employees and retirees to be informed.
All right, thank you. Anything else on item number 10? Okay, hearing none, we are adjourned at 11:04. Thank you, everyone.